Good morning, everybody. It is 8 a.m. Pacific Standard Time. Thank you for joining us. Please say hello. My name's Keri, which I'm sure you know, and I have the honor of Dave Childers, the master of Keeping Current Matters, which is an incredible company with so much data and information, and he's a very hard person to pin down, and honored to have him with us today. We've always been big supporters through the Tom Ferry organization of Keeping Current Matters, and was definitely one of the first people to get on board. And I worked closely with Sarah.
Yeah.
Elks to start working on webinars and helping with Instagram ideas, and she's just put herself out there in a lot of ways too on video, which she's a great inspiration, not being a real estate agent, but just another person. She didn't want to do videos, and we always talk about how insecure we are, and she's doing them all the time. And so it's
first of all, thank you for having me on today, Keri. We're grateful for your influence and help and advice and expertise that you've given to Keeping Current Matters over the years. So know that. And I'm excited to be here today. You were talking about video, not wanting to be on video. I'm convinced in my life, the only way you get better at video is by doing video. I don't have another solution for you, and so you're an expert at it, and no doubt that you've gotten that way by just doing it, by getting out there and, and doing it.
Thank you. Do the thing, have the power. Yep. The evolution of videos come a long way. And luckily for KCM's Real Talk, it's a lot easier to deliver videos of value to your clients versus filming them yourself or hiring someone, and the whole setup and the expense of it all. So,
Yeah. So that's been the newest product we've released. People always have said, hey, how do I record a video and use the words, like KCM does? And so that's what that product does, is gives everybody the words to say, what's happening in the market, what are the insights. And
exactly.
Here's something I would ask, if folks are in, I can see folks in right now in the chat. What are the questions that you have? I'm going to keep the chat open, Keri, as we talk, and as I'll hop into slides in a little bit. But if you have questions, ask those. We could even, at the end, do Q&A or do something like that. But let us know if there are questions. Let us know. I'd love to see where everybody's from. Is everybody in your area in LA, or is everybody, people from other places?
I think people are mostly all over. Yeah. Okay. Let us know, everybody. Let us know where you're from. Feel free to put in your Instagram handle, connect with each other, share things about your market. We'd love to hear from you. What we'll do is Dave's going to go into some market insight, talking about the market, what's next, share some slides. We're going to talk a little bit about Los Angeles market in specifics with what's going on, get some insight from Dave, and then we're opening it up to Q&A. But if there's any burning questions, we can always pause to take some of those, but that's the general format of today.
So I see in the Q&A, it says chat is disabled. I don't know how to.
Okay. I'm going to ask Bev about that.
But Paige, see you there from Aspen. Gosh, that sounds like a good place to be right now.
Yeah. Okay. Okay. Jose, everyone. Chat is enabled.
All right.
Somebody send a chat to make sure it's working. I usually have Bev with me here to help with my webinars. There we go. All right. Los Angeles in the house. We have Denver, Pompano, Florida. I love that city name. Maryland, Colorado. Rich Turnbull Test. Thank you, Rich. We've got Los Angeles. Simon Price. Good morning. It's great to see everybody here today.
Sarah's on here. See her there. You were mentioning her before. Sarah from the KCM team.
Yay, Sarah. Thanks for joining. Sarah Gus. Proud mama of 3 now, right?
2. Yeah.
Oh, 2. Okay. Colorado. Hi, Sam. Sam, you've been so helpful in setting us all up. Thank you for that. Okay. Yeah. Don't forget your Instagram links. Hi, Gloria from Los Angeles. Okay, good. We got a lot of LA people here today. The Agency Palisades. Hi, Trevor. We're rocking and rolling. All right. Well, whenever you're ready, I guess we can start with questions. You guys ready to get started?
Yeah, let's do that. Here's what I'd recommend. Let's do this. I'm going to start out. I've got a few slides. I can't show up without a couple of slides.
Of course. That's why we love you.
Do that. And maybe I'll go through a little bit of a presentation. And then as you have questions, if you're watching, drop those in there. Somebody's got a referral for you too there, Keri. In there.
Great. Call me later. Okay, Bev, write that down.
That's great news. So here's what I was thinking about doing today. Talking first about where we're at. Right now. Okay, where are we at in the real estate market? Then I'm going to cover a couple of projections, and then I'm going to give you sort of the case for why prices are where they are. And I'm going to show you what I believe to be the biggest piece of information that is convincing that this real estate market is not going to be a crash. It's not going to crash. Okay. That we're not because I think, fear and everything in the business is at a fever pitch right now. Folks are concerned, and I'm not saying that's not real and legitimate. It's out there, and there are things that we need to be concerned about. But understanding what's going on is key for right now. Okay. Yes. So that would be what I would propose. So I'll kind of go through the next few minutes and have a few slides, maybe take 20 minutes, 30 minutes and do that. I know you're going to do your local market update, and I'm excited for that. We can do some Q&A as well. But here's where I would start. There was a book written back in the 70s called Future Shock. I don't know if you ever read it or have ever seen it. It was written by a man named Alvin Toffler. And he said this. He said, future shock is defined this way. I've got it up on my screen. The shattering stress and disorientation that we induce individuals by subjecting them to too much change in too short a time. Okay. Wow. I don't know that there's a better quote of where, and my sharing is disabled. If you can have them enable that, but I don't know if there's a better quote than that for where we're at right now. I'll show you that quote really again. The shattering stress and disorientation that we induce individuals by subjecting them to too much change in too short a time. That's the real estate business right now. That's where we are. If you're wondering where we're at, we're right there. Okay. This is a book. It goes on. There's a fascinating book, and he says many other things. One of the things he says is the future will be defined by data. And I'm like, well, you probably got that right, back in the 70s. But here's the bottom line. In real estate today, we're experiencing an enormous amount of change. Anytime you go through change, that can lead and has led to uncertainty, right? I don't know what's coming. You and I were talking about this as we started. What's on the horizon? If you don't know that then leads to fear, right? In fear, if left unchecked, leads to paralysis.
Yeah.
You don't do anything. If you're scared, that's what our bodies are designed. Like, I'm gonna stay right where I'm at. I'm gonna sort of put my hands in my pocket and let this all sort itself out, and we'll figure that out. That's where we're at.
Right.
So my hope this morning is to give you a little bit of a snapshot of what's happening. Today is a very, very interesting day. We're going to get the Fed meeting today. We're going to get their press conference this afternoon on what are they saying in the economy, the Fed funds rate, which, oh, by the way, is not mortgage rates.
Right.
We actually have a scenario that we could see a raise in the Fed funds rate and actually a little bit of relief in mortgage rates today.
Interesting.
Not guaranteeing that, but that is certainly a possibility, and I'll explain why in just a minute. But no doubt right now, this enormous amount of fear has led to uncertainty, and people are all over the country wondering what's going to happen in real estate.
Yeah, that is really the term. Future shock really defines the last couple of years, especially recently. We as a world have been through so much. It's really insane with being away from families and not being able to travel to family, and the economy, stocks up, stocks down, the riots. It's just yeah.
So let me kind of break this down a little bit, because first of all, nobody in this world has a crystal ball. They can't tell you what's coming 6 months from now, 4 months from now, but I can tell you exactly what is going on. And I'm going to break down where we've been and what's kind of happening. So first point here, define reality. This is reality in real estate over the last 6 months. It's the average 30-year fixed going all the way back to the first week in January, right at 3%, 3.2%. Average 30-year fixed this past week, 5.5%. We kind of clipped up there in the sixes for a few weeks, but the rise in interest rates has made it more expensive for people to go out and buy a home, buy a lot, right?
Yeah.
I mean, the average home in this country, about a $400,000 home. I know that's not, in your area, Keri, but it's added about $800 to the financing amount of a home. And
800.
folks are like, I don't know if we can do this. And again, they kind of put their hands in their pocket and go, we're going to wait. And we're seeing that rise in interest rates moderate the market.
Right.
Now, what I want to explain to everybody is exactly what the Fed is up to. And I mentioned the Fed meeting today. All of this sort of jump and shift in the market happened about 30 days ago when the Fed came out and essentially said, inflation is not under control and we need to get more aggressive. That's what caused this in the last month, where we've seen a market shift in the real estate market relative to the cost to borrow money.
Right.
Now, what you can't predict is if people that are saying, hey, in the midterms and what's going to happen coming in this year, where are rates going to be? Can't predict that, but I can absolutely tell you what the Fed is doing. And this is a quote from the Fed chair's statement about 30 days ago. He said this: I'd say if you're a home buyer or somebody or a young person looking to buy a home, you need a bit of a reset. I don't know if anybody caught that or saw that or in the statement heard that. But
it's a big statement.
Yeah, we need to get back to a place where supply and demand are back together, where inflation is down low, and again, mortgage rates are low. Okay, I want to break this statement down in three parts. First part here, we need to get back to a place where supply and demand are back together. The Fed does not control mortgage rates. They can only influence mortgage rates.
Right.
Okay? So they influence mortgage rates down during the pandemic. And what they're doing right now is they are taking action specifically in the economy, which is having influence. It's all about inflation right now. And remember, inflation is the enemy of mortgage rates. And so in this, what are they doing? They're trying to get more supply in the market, and they're trying to bring demand down. Well, what's happening? Exactly that right now.
Yeah, right.
They're bringing demand down by raising the cost and supply. I always use the analogy of a bathtub. The last couple of years, our business has been like a bathtub. We've been trying to fill the bathtub with the drain open.
Yeah.
We're trying to do that. You can't do it. All the water's coming through. And now that the drain's getting stopped up a little bit, more inventory is accumulating in the market.
Yeah, that's a good way to put it.
The other way we know that is inventory is coming at a little bit faster rate. We've covered that in Keeping Current Matters. You can see this year over last year, we're getting more inventory into the market. Maybe those that think, did we miss out, or we want to still get it our home in the market and not miss this market. But no doubt that is what's happening. The second thing is all of this is in service of inflation, where inflation is down low. Now, I mentioned that we could see a scenario today where the Fed actually raises rates, but we get a little bit of relief in mortgage rates. Why is that? Two specific things. If the market signals and feels like, what they're doing is helping, and the potential R word, the recession word, those fears are growing. Okay, so that's going to be something that the mortgage market is going to look at, the bond market and the secondary market. So be on the lookout for that today. We'll certainly have commentary on that from Keeping Current Matters, but everything they're doing is to get inflation down low again.
Right.
That's the game. And all of us feel it, at the gas pump, at the grocery store, wherever we're at.
Hotels, everything, clothing, food,
absolutely,
trash bags.
Right. So if they can sort of bring the frenzy out of the market, get inflation down low again, then they said and mortgage rates are low again. Okay. Now, I don't think we're going back to 2 3/4 like we saw in 2020 and 2021. But I think even psychologically, we break that barrier, through the 5s into the 4s. It's going to be different for people.
My question is this really impacting the price of goods out there? Because it's affecting the real estate market, but where is it affecting the rest of our world? Because I haven't seen that.
Where is inflation affecting?
Yeah, right. If they're raising the rates so people stop buying homes, it's not touching the inflation problem yet, is it?
Well, so there are a couple of things. The Fed funds rate is an overnight rate that banks charge one another to basically balance their books. And the second piece of that is a lot of credit cards and a lot of things that are tied to prime rates start to go up. So the cost of borrowing outside of housing goes up. that's what then begins to slow the economy. And so absolutely that is what is happening right now. And you're seeing earnings reports coming in saying, hey, we're starting to feel the effects of that. And the second thing that you're seeing as a part of that is inflation right now is heavily tied to energy, to gas prices.
Right.
It takes gas to get everything everywhere.
Right.
And so the Fed does not have control over gas prices. So a little bit bigger question, something that's kind of outside of our control, but it'll be very interesting to watch. But here would be my point. The bottom line is inflation is the issue. Inflation will always be the enemy of long-term interest rates. Right. So when inflation's high, you can expect the cost to borrow money to be higher. Okay.
Right.
And so that's what you need to watch. Okay. The Fed's going to do what they're going to do. Things are going to happen, whatever's going to go on. But what you want to watch is inflation. So what does that mean in inflation? Many of the folks I know that checked in and were in the chat before follow Keeping Current Matters. The bottom line is I would be using a graphic like this, whether you're in the business or you're maybe a consumer watching this, is to understand how has inflation affected the housing market.
Yes.
Because that's what we need to watch. And the bottom line at Keeping Current Matters, we went back into a study all the way back to the 70s and
Great
said, let's compare home price appreciation to consumer price increases or inflation over the decades. And you can see in just about every decade, home price appreciation outperformed the inflation rate. So in any inflationary economy, you want to be in something that's going to outperform inflation. Whereas, you don't want to have money in the bank. I'm not saying don't have money in the bank or reserves. You absolutely need that. But you want to be invested in assets that are going to outperform at best, if not keep up with inflation. You go back to the 70s, the 80s, really neck and neck in the 80s, 90s, 2000. Inflation slightly outperformed home price appreciation, but we had the housing crash. We know what was happening there.
Right.
Certainly 2010s in the last couple of years, home prices have outperformed inflation. But here's the bottom line, Keri, and I'll pause here for a second so we can talk. But until inflation peaks, mortgage rates won't either. And without improvement on the inflation front, we don't know where the interest rate ceiling will be. That came from Bankrate, from a quote that they gave. And I think that's probably the best way to look at where we're at right now is it's all about inflation. It's all about what the Fed is doing to try to control that. And, we'll watch and see what's going to happen.
So that's an excellent recap. And those slides are so impactful. That's always been one of my favorites, is inflation outpacing home prices, outpacing inflation. I mean, and look at that statistically. And, a lot of what's happening with this fear is we as humans are built to know and recognize history. So historically, we are used to seeing the housing market go up and go down. We've never, ever been in this world we are in now with this population and with these millennial home buyers that are, up to their late 30s, early 40s. So these people are first-time buyers and they are move-up buyers, and they're the largest generation of humans to ever purchase in history. And a lot of them went through that original crash. Maybe they were part of it. Maybe they lost a house or lost money. So
their parents, for sure.
Their parents, yes. So you get a lot of even older, like the actual baby boomers themselves. Like they're like, the cycle should have ended 7 years ago. This can't be possible that home prices can increase. So speaking to that, what do you see for the rest of the year? How can you speak to those type of speculations and that fear out there?
Yeah, I'll talk about that in a slide in just a minute. I'll give you projections for mortgage rates, prices, and home sales. Okay, I think those
amazing
are things that are very, very important. But here's what I want to underscore right now. I'm going to give you a numbers-based, sort of look at this, but we have to understand what you just said, that this is an emotional conversation.
Yep.
The word recession and its tie to housing changed in 2008.
Right.
People looked at what happened there, and it's sort of what they think this is what's going to happen each time.
Yeah.
Have this scenario. We did a study at Keeping Current Matters. I don't have the slide with me today, but if somebody wants it, they can email me. That recession doesn't equal housing crisis, where we looked at the last 6 recessions, and 4 times home prices actually appreciated. One time in the early 90s, they slightly depreciated, but what everybody remembers is 2008. I'm going to show you a slide at the end that really speaks to that, because it's probably one of the most important ones that we have. But let's look at projections. Now, I want to say something about projections before I hop in here. What happens with projections? Forecasters project up and they project down. Prices.
Right.
Let me give you a great example of prices. I'm going to show you the latest home forecast. In January, the home price forecast for this year was 5%.
Yeah.
Average aggregate across 5%.
Yeah.
Right now, you're about to see where it's at. So they've adjusted up their forecast. And at times, even going back to 2020, we saw high projections at the beginning of the year, lower projections in the middle of the year, the actuals end up higher.
Right.
Okay. So they're moving projections. Don't get caught up on, is this perfect? This is the expert's opinion on what's going to happen in the market. So let me share this with you. First,
the same experts who have been predicting the market for 30 years, by the way.
Absolutely. Absolutely. Yeah. So mortgage rate projections right here. You see, we took Fannie, Freddie, MBA, and NAR, averaged all four of them out from the fourth quarter of this year through the third quarter of next year. And that's kind of how they start to project here. What do you see getting into the fours sometime, next year after the middle of the year? Now, I think this is all going to depend upon inflation, recession, and economic factors. Okay. So likely looking at, and again, historically speaking, low fives and into the fours, great 30-year fixed on a mortgage.
Yeah.
I understand that over the last couple of years, we've seen dramatic price appreciation. It's gotten more expensive. Folks are concerned about that, and rightfully so. I don't want to diminish those concerns, but that's a look at what experts are forecasting about rates.
Yeah, I like that.
Yeah,
that feels good. So, people were saying double digits.
I don't see anybody right now forecasting 9 or 10%. There are certainly doomsdayers that say, this is going to happen, that's going to happen, and we're going to be at 10% before you know it. I don't
That's
see
a great point
right now. Yeah.
You have to listen to the right people, because the headlines are saying that, and then you have expert here who is not actually seeing that. So it's so important to know where you're getting your information from.
Yeah, absolutely. So let's look at home prices. Remember, I said we started out the year at 5%, currently at 9.8%, the average of the 7 forecasters that we follow. You sent over an article to me about LA prices, Keri, this week, and certainly seeing asking price reductions.
Yep.
But forecasted for home price appreciation. Why is that? Well, in that article that you had given me, Keri, share with other people,
in the LA Times,
you look at the end of the year last year, or even a year ago, where prices were at and were well above those. So, pricing strategy across the country is, what do you think we can get for the house? Great, add $50,000 to it, or add $100,000 to it.
Right.
That's been pricing strategy for the last year. So
of course,
you're seeing prices come off some of that aspirational pricing on asking prices. I'm not saying there's not markets out there that are overheated, but there's not a case to be made nationally for home prices to decrease. And you certainly see that in these forecasters.
Right. So that's a very good point to note, that with the Southern California median price going down by 10,000 month over month, June to July, it's, even if it tapers off a little bit year over year, you're seeing huge gains, and it shouldn't be going up 20 to 30% year over year anyways. So it's just creating a lot more fear.
Absolutely. And I'm going to talk about, there's an article today on mortgage applications on CNBC, and I'll give you a little clip out of that article in just a minute, but that's the look for home prices. What about sales?
Okay.
Most recently, June's most recent existing home sales numbers. This doesn't include new homes, but 5.1 million in the seasonally adjusted rate. That means if the year ended today at the pace that we're going, we'll sell 5.1 million homes. Well, what the signs are very, very clear that we're heading into a market that's very, similar to pre-pandemic markets of 2017, 18, and 19, although at a higher price. I will certainly acknowledge that, but 5.1 million homes on seasonally adjusted rate right now selling in this country. And so you look at mortgage rate projections, you look at prices, you look at the number of homes. Forecasts are right at about 6 million homes to sell in this country, and gosh, that is a good year in real estate. Certainly headwinds, certainly things happening in the market that we need to be concerned about, need to be educated on. That's what I'm going to go back to. You need to be educated on this, because there was an article that came out this morning on CNBC. It said mortgage applications are down, refinance applications are down by 83% or something like that.
Pandemic levels.
It certainly makes sense. But they said this in that article. So if anybody gets that article shared with them today, or somebody sends it to you, Keri, what do you think about this? My question always, if somebody ever sends me an article, I ask them, the first thing I ask is, did you read the article?
Right.
Because we live in a world where people are informed by headlines, and they're just like, we're gonna take that and not even read the article.
Right. Exactly.
So many of these articles are using those clickbait headlines that are, maybe factually correct on some level, but very, very, misleading in their indication. But that article came out on CNBC. You can go find it this morning. But there was an interesting little nugget in there that I pulled out. The title was "Mortgage Demand Declines Further." Came out this morning. Says this: there could be a potential silver lining for the market, he added, as stabilizing mortgage rates and rising inventory may bring some buyers back to the market during the second half of the year.
Right.
I'm going to pull this down for a second. We're in a market right now, Keri, where no doubt it's gotten harder. I'm not going to act like it hasn't gotten harder.
Yeah.
But many felt like buying a house over the last couple of years was impossible.
Yes.
And we're not in a market right now that's impossible. We're in a market that's much harder. More inventory is coming into the market, more choices for those thinking about buying. If you're thinking about buying right now and you didn't do it over the last couple of years because you were outbid or price or whatever the case may be, being able to go back and say, okay, there are more options right now. Look at, with a lender, what are the financing options? We're seeing more adjustable rates in the market right now. An adjustable rate mortgage is not a bad product. It's very effective. It's right for your needs for financing a home.
Yeah.
So that's what we're seeing right now.
Yeah. And, speaking to that, so there are a lot of buyers who had a horrible time this year and basically impossible to purchase something. So as the market shifts, the logical answer is, great, you have opportunity, but the emotional response for most home buyers, market shifting, I'm not going to buy now.
Sure.
So what are the answers to those conversations for consumers or for agents speaking to their clients?
Yeah, let's break that down, because I think that the price piece is a big question, right? And if you qualified for something at the beginning of the year and then you go try to qualify for that amount now, you may not be able to afford it, right? Nobody wants to look at a more expensive home and then like, hey, I don't like the ones that we're looking at now that we can afford.
Right.
So I think that's the reality, but here's an even bigger reality. Nobody wants to buy something today that's worth less 6 or 12 months down the road, right? I'm okay with paying a little bit more, but I certainly don't want to pay more for something that's going to be worth less. So I want to give you the case for that, on what drives pricing in real estate.
Perfect.
And what I told you, I'm going to show you what I believe is the biggest sign that we're not going to see a crash in the real estate market, okay, like we did in 2008. So let me share my screen here. I'll use a Dave Ramsey quote. Those have been floating around the real estate business for the last several weeks, but he said this, and I absolutely agree with it. The root issue of what drives home prices is almost always supply and demand.
Yep.
Now, interest rates affect that. When interest rates go up, guess what? Fewer buyers. That's exactly what we're seing right now.
Yep.
The demand goes down, thus prices are going to soften or not be as cray-cray, that's his word there, as they have been. And that's exactly what we're seeing right now.
Yeah.
Okay? So supply and demand are what is always going to govern prices. And that doesn't matter if you're selling homes, you're selling another product. How many do you have and how many people want it? That's always going to determine price. That's economics 101.
Yep.
Okay. So let's break that down in this country relative to U.S. real estate. There are two graphics that I would use in that. So first one, this is a look at supply. This is single family housing units. So, new homes brought to market going all the way back to the 70s. And the blue bars there are the number of homes built leading up to the crash of 2008, the housing crisis. And there were 4 years actually leading up to the crash. There were more homes built in this country than ever before. It had never happened. It hasn't happened since. More than 1.5 million homes built 3 of those 4 years. And so after that, builders were at the epicenter of the crisis that faced real estate. And I can break that down further, but builders kind of, built all these homes. People said, look, we can't afford these homes, and we didn't qualify for them, and we know what happened there, in the mortgage crisis, and a lot of builders had to get out of the business. So for the last 14 years, we haven't built the number of homes in this country that we've needed for the number of people that have wanted them.
Yep.
So the 50-year average is that dotted line there in the middle. And people have asked, why didn't it feel like there was such a housing shortage on all the years leading up to the COVID years? It's a great question. There are two answers for that. One, the meaning of home changed over the last couple of years.
True.
People said, we need something. We're willing to pay for it. We need a place to, educate our kids. Maybe we eat there, we work out there, we're working there. We need a different solution.
Yeah.
The second thing that happens is we saw historically low interest rates, 2 3/4 in a lot of places. So people said, if we're going to do it, now is the time, and they did it. Right? We sold more homes last year than we have in quite some time. And so, you look at that, and that's been the look at supply in this country. Now, builders are building. Forecasts are over 1 million homes built this year. They're coming back. They know there's opportunities. Certainly, that is the case. But they cannot build enough homes to satisfy the number of homes that we are behind. And depending on the studies you look at, 3 or 4 million homes under here in the U.S. So that's the first point on the supply issue in this country. That's why, remember, anytime you have less of an item, more people want it, price goes up.
Right.
The second piece is exactly what you just mentioned. You have one of the largest generations in the millennials moving through their peak home buying years. And what we know based on NAR's profile of average buyer and seller, peak home buying years are 21, I believe, 22 years old to 33 years old. You have this massive amount of people moving through that age range. I'll give you a very interesting statistic. Do you know last year, 81% of first-time home buyers were millennials? They put in the box right there. 43% of all buyers were millennials. So when you look at that age range and you see that happen, you have a tremendous amount of demand moving through a market that has been supply constrained because of the issue with builders and bringing new products to market. There are 3 ways that a home can come on the market: an existing home, somebody decides to sell their home; there's a new home; or there's distress sales. There's foreclosures or things like that. And we certainly have not had the amount of new builds to keep up with the growth that's happened in this country. And anytime you have that, and I'm going to take this down for just a second. Anytime you have that, that's going to keep upward pressure on prices. Now, I'm not suggesting that we're going to move through the next few years and see the growth that we saw over the last couple of years. Not at all. I think we're moving into a flatter, more, actually home price expectation surveys around historic appreciation. The average appreciation in this country has been about 3.8% in real estate. So I think we're heading into a market that's going to be much more like that than anything else.
Yeah, it's great points. Really, just such golden nuggets here. And I remember one of the biggest things with the crash, 2006-07, is prices were starting to go down, but the amount of homes being built, just per your slide, there's new home builds everywhere. Think of all the outskirts of major cities like Lennar and KB and Toll, like just tons and tons of home. And now, obviously, all the builders, they haven't been building as much, but also supply chain issues. They can't even get sinks and windows and things to finish their homes. So it's just such a flip. And, that's a lot of consumers don't have that information out there.
So I think that is the question. Why are we not going to see a crash? Because if you said we're going to see a crash and here's how it's going to happen, you'd have to make a case for it. And listen, I've seen a lot of cases, people that are like, everybody's going to lose their job. That means they're going to have to sell their house. And, this not a likely scenario in that. I'm not saying that economic slowdown is not going to affect people, because it will, right? That when the economy slow down, when business slow down, that affects people. But let's go back to what I talked about before. There are 3 ways that homes come on the market: existing home sells, a new home is built, or there's a distress sale.
Yes.
The issue in 2008 is that we really had inflated demand in this country
Mhm.
because you didn't have to qualify for a mortgage, right? We joke around and say it was easier not to get a loan than get a loan back then,
Yes, it's
right?
very
Many
true.
of us that were in the business know that, understand that, and probably feel a little dirty, like talking, it's one of those things that you're like, gosh, I can't believe we did that. But that was the issue, right? And so you got 100% loan at that time. Prices started to change, and that's where the word strategic default came into place. People walked away because they owed more on the home than it was worth, and that was the market.
Mhm.
Okay. So what comes along? I want to explain this to you and I don't want to get super technical here, but legislation came along, the Dodd-Frank Act, which was intended to protect consumers, and people can debate that or whatever. But as a part of that was this term called the qualified mortgage. Okay,
Mhm.
QM mortgages. That's what came about after 2008. Well, in that, the basis of the qualified mortgage is, does the borrower have the ability to repay? Which I always joke around and say it's a pretty novel concept on loaning somebody some money. Do they have the ability to repay? So Dodd-Frank said you cannot issue a mortgage. Now there are non-QM loans in the market, but the vast majority of mortgages are governed by the non-QM rules. I mean, by the QM rules,
Mhm.
and they have to demonstrate the ability to repay. So in that, when you have a more qualified borrower, what you see is less foreclosures.
Mhm.
Okay,
Yes.
and I'm going to show you kind of how that's happened in this country. Let me share my screen real quick,
Great.
because this will help illustrate this point. This is foreclosure activity by year, going all the way back to 2008. See, the blue bars there in 05 and 06, then the red bars during the housing crisis, over 1 million foreclosures every year in the housing crisis. Back then, over 9 million people went through a foreclosure in the housing crisis. And I certainly wouldn't say, if you say, well, David, looking in the rearview mirror and showing that is not an indicator of what's going to happen in the future. And I agree 100%. But here's my point. Ever since 2011, we've seen fewer foreclosures every single year. And even take 20 and 21 off the table, because those are anomaly years.
Yeah.
There were moratoriums in place. I'm not talking about those years. I'm talking about the credit worthiness and what's happened to the consumer during that time. Because there are two very, very clear things. I'm going to pull this down real quick. Two very clear things happened. One, it got harder to borrow money.
Really hard.
And any of us that have been in the business understand that, know that. Maybe even if you're not in the business, you went to get a loan. Certainly, if you're self-employed, you know that's been very, very hard. And second, people said this: we're going to do things different this time. We're not going to take all the money out of our house and go out and buy a jet ski and go on vacation and think this is never gonna end.
Yeah.
People said, you know what, we're going to be conservative with our home. We're going to maybe try to pay it down a little bit. We're certainly not going to leverage that cash. We're back in 2008. People were like, who cares? Who cares if we bought it for this price? It's going to be worth $100,000 more next month.
Of course.
There was this, what they coined the term back then was irrational exuberance.
Mhm.
Okay, we've certainly seen crazy pricing over the last couple of years. I'm not denying that. But what we've also seen is the average equity in a home grow during that time. Tappable equity grow during that time.
Absolutely.
And to me, that is the biggest case to be made, that we're not going to see this wave of foreclosures come on the market and lead to this crash and this crisis in housing. If I was out there using a visual to show someone that, I would absolutely show them that and say, okay, this is how the market breaks down. Because doing that, Keri, is going to help people understand what's happening. I don't want to convince anybody to do something they don't want to do.
Of course.
But if they're frozen and not wanting to do something because they've been misinformed, I want to absolutely step in there and be the educator.
Yeah, that's been the conversation the last couple of years. Is we have the facts, we know what's going on, even with all this fear, and people watch others, and as soon as they jump in, they jump back in too, and it creates a frenzy all over again. Some people are obviously priced out, which will change things, but it's really such a good time to get into the market if you weren't able to, right? And it's a breath of fresh air. I've been saying in LA, like we were at one of our desert houses with a group of best friends in March, and all agents, and we're just like, this market sucks. It's exhausting. 500 over, a million over. Like it was a horrible market to be in. And as soon as the market slows down and becomes normal, it's like, oh, the market's crashing. You're like, no, the market's amazing.
Somebody's like, we haven't sold our home in 2 weeks and we're getting worried.
Oh yeah. Yeah. One weekend, they're like, what's going on?
Yeah.
30, 60 days used to be the norm.
Yeah.
Not a week.
Absolutely.
Yeah. Should we jump into some LA facts before we have to end? Okay.
Absolutely.
So we'll do a little share on what's happening in Los Angeles. And let's see here. All right, share. Everybody can see that? Okay. So this is from our MLS. They put together these quarter snapshots for us, which is really great. Here we'll look at starting with single family homes. So we're looking right now at comparative second quarter. So second quarter of this year versus the last 2 years. And I like that they pull up 2 years. So we'll start here with median price. So you can see here from 2020 to 2022, the median home price in Los Angeles increased all the way from 1,328,500 up to 1,850,000. So that has been a big jump. Obviously, a 15.6% increase just year over year, which is incredible. But what the media likes to focus on are these two numbers: how many houses are selling and the volume of houses selling. And they focus on that being down so much, even though the median price is still going up. So we're seeing this significance in the inventory from these numbers here, from the sales volume and the number of listings sold. You'll see a 19.67 decrease in the sales volume. Well, why is that? Look at 2021. That was an incredible time to buy. Inventory was higher, rates were insanely low. The pandemic was in a better place. People were feeling more confident. Maybe masks were off that week, or you could actually go into a restaurant and eat that week, who knows? But we had a little bit more freedom in our world. And the sentiment on consumers is like, it's a good time to buy. Everybody was trying to buy. So in addition, you can see from our inventory levels, we show a 23.9% decrease in the number of sold listings, which you can see here, 2021 of 2,116 homes being sold, like really was the golden year. So that's a lot of stats. I know we've been doing a lot of stats today, but don't worry, this is all recorded. Let's look at the heat map. You're curious about what the hottest areas are in Los Angeles. LA is a very diverse city, a lot like New York. Every little submarket is very different. But when you're looking at the beach cities versus Beverly Hills versus the East Side, we see dramatically different prices. So let's take a look at this climate map. Now, this is wild. So the brightest red here indicates 20 to 30% increase in those areas. So if we look at these red, you have Pacific Palisades up 42% this quarter versus quarter 2021, 42%. So the fact that things went down $10,000 last month, everybody should be happy about that. But look at Eagle Rock, 65%. You guys, that's year over year. Of course, the East Side, that's where you used to be able to get a cute little bungalow for $600,000-700,000. Not quite the case anymore. And then you've got areas like Metropolitan Southwest, which is around Inglewood and the Forum, all the gentrification that's happened there. And then Cheviot Hills, look at that, 55%. Cheviot Hills is known as being a more expensive, well-to-do neighborhood. It's where they have the house from Modern Family. That market was hit huge with developers because they were in Brentwood, Santa Monica, Pacific Palisades. Things were getting bought up so fast that you really couldn't get anything under 5-6 million to flip. So they focused on Cheviot, which is a beautiful area. So the lighter the colors, and then even the blue shows decreases. So even in a city on a whole that can rise 15.6% quarter over quarter, the submarkets tell so much information. Then, you could have a couple lower sales that drive things down, but it's really incredible to look at how these cities particularly have been doing. Does that mean there won't be a boost in, say, Beverlywood, Beverly Hills? Some of these areas, they just don't really ebb and flow as much as outer cities. Like when people are rushing to the east side to find something, to the valley, out to other cities, they tend to have a bigger boom because people can't afford here. But these prices overall, these ones that haven't had much of an increase, these are the highest priced areas in Los Angeles. So let's look at, this is single family homes. So let's look at the condos. So in Los Angeles, this isn't the same as all markets, but in LA, we have a huge condo culture, townhome culture, because to buy a house, you're looking at 3-4 million in most good areas, or at least two. So for a lot of people, making 100, 2,000, 100 a year, they need to focus on a condo, and condos are great. They're a way to step into a bigger home. I'm always a fan of first-time buyers getting into condos if they need to. So we'll look at the same stats here. The median price for condos actually increased higher than single family homes, 20.8%. And then look what they did 2020 versus 2021. We're looking at 8,250 increase year over year. That means it was basically flat. So you can see the condo market comparative exploded a bit 2021 to 2022. And, why is that? As home prices were soaring, condos became the most available and affordable thing. And people weren't as worried about sharing spaces, touching buttons as, the pandemic changed. Now, when we look at the volume and sold listings here, you can see a difference. We have a 5.13% decrease versus SFR, which was 19.67. And why is that? Well, that's just because the median price went up more. So it balances it out. Condos have been a safe bet in LA finally after having such a flat couple of years, which is great. So if we let's look at the heat map for condos, because I love this. Where are the hottest condos right now? They are not on the east side. So where everyone is rushing to get a bungalow, and they're going up 50, 60%, they are seeing decreases, a lot of decreases. And where are condos going up comparative? I mean, look at this, Brentwood, 25%. Pacific Palisades still leading the charge on this, 65%. So they're up 40% in single family homes, condos 65%. Pacific Palisades, if you know or don't, I mean, maybe because Rick Caruso built his village there, but it's a beautiful beachside community, and it's really kind of under the radar. Most people don't know about Palisades. They know Santa Monica, Beverly Hills, but Palisades is an amazing place to live. But similarly, it's almost like there's a switch on the places where condos went up in value, but not homes. And this, I truly believe, is strictly to do with affordability. If you want to be in these cities, you can't get into a home, you take a look at condos. So it's interesting to see. And, if you're a home buyer, maybe take a look at these areas that haven't had as much of an increase and snag a better deal there, because eventually everything goes up. But, we've had such a volatile couple years. So it's interesting to see these stats. I mean, even look at Malibu, 124%. That's wild. Malibu was also impacted by the fires from, I think, 2018. So their market went completely flat, but eventually started to increase. So in all reality here, we're watching the trends, and we're watching the median prices, and we don't want to just wait and see what's happening. We really want to be able to take advantage of what's happening in this market now, because even if prices go down a little bit with rates inching up higher, you're going to be spending more money monthly. And that's the biggest piece of conversation, right? And if you're trying to make a move in Los Angeles, we encourage to look at all the data and look at the future and take a look at what your monthly payments will be, what to expect, and make an informed choice for you and your family, because it's really about your lifestyle and not about timing the market. So yeah, I'm going to stop sharing that there. So that's a little bit about the LA market. Of course, there's a lot more details, and depending on where you're looking, we can dive into that a little bit more.
Yeah, no, it was a great analysis. And that's what I would say about, we talked about on the front end of this call, what's happening nationally. But I think for anybody, right now that's looking, it's about what's happening in your neighborhood. You did a great job of that, Keri.
Thank you.
Down. So
Yeah. So overall, everybody's just waiting and watching, but the only way to get something done, I think, is to take action.
Yeah, absolutely. So I think we have 10 minutes left. We want to do questions. What do we want to do?
Of course. Yes. Does anybody have questions that I know, a couple of people texted me like, this information is so amazing. I don't have any questions. I'm just overwhelmed.
Okay.
Which is great. Yeah, let me know. Someone had asked where we can get all this information. Keeping Current Matters. So if you're not a member, but if you're a member of Keeping Current Matters, you can log in and get all the slides. Happy to share some in the meantime, but Keeping Current Matters is an incredible resource. I believe it's $29 a month, right?
Starts out at $29 a month. Yeah. So I'll send you all these slides. I think you have them already, Keri.
Yes.
Anybody that wants them can get them from you, or you can start a KCM subscription and go grab stuff like this anytime.
Perfect. Yes. And if you're a real estate agent and you're interested in the Real Talk, we have a coupon code from me that offers a discount for the first 3 months. So happy to share that as well. Just send me a message and we'll also send a note out to everybody who registered. And yes, this is recorded. We can send that out to people. And we have a question here from Gloria. Thank you, Gloria, from Los Angeles. What is the expectation of new construction growth as we navigate through this? Will there be more building or not?
Yes, is the answer to that. There's more construction happening. I'm going to pull up a slide.
Okay.
So I'm going to show you that nationally and what is going on with new construction as of June. So let me share this real quick. It's a great question there.
Awesome.
So can you see that?
Yep.
Is that being shared the right way? So this is a look at new building permit starts, under construction, and units completed. So if you can see that, this is a number of permits. So that's permits and starts are going to be what builders are going to refer to as leading indicators. If you don't have the permit, then you can't start, then you can't put under construction, ultimately completed. So what's happening with permits and starts? Clearly down right here in May and June, and starts down. Why is that? Because builders sense, this market is changing. Let's not do it like we did in 2008. See a reoccurring trend here, Keri?
Yeah.
Let's maybe ease off the gas. And so you're clearly seeing that from builders. Under construction has been growing, but is plateauing right now. Seasonally adjusted rate of 1.5 million homes under construction. Now this becomes interesting because we talked about, okay, our new units coming to market, either existing home build or distressed. I covered distressed just a minute ago. Now what's going on with completed units? This is at a seasonally adjustable rate of 1.3 million homes.
Wow.
So yes, builders are building, but they're showing very clear signs that they're pulling off the gas, right? What do we see from headlines and builders? Contracts canceled. Folks that I think in a lot of cases are two reasons for that. One is you qualified for something that now that you can't afford, right? That's a reality in the world today. The second one is everything that we talked about. I'm unsure of what's going to happen. So we're gonna pause. We're not gonna do it.
Exactly. Yeah.
The new construction is absolutely coming to market. I don't see that as anywhere near the number of units it would take to catch us up in the deficit in this country. And clearly there are markets in this country where builders are building, and there are markets where there aren't, simply because there aren't options in a lot of cases. There are a lot of tear down, a lot of backfills and things like that.
Yeah, and it was also that a lot of cancellations happened because people could cancel. People were writing non-contingent offers and they actually would find termites or foundation issues, and they're like, I am going to cancel because I have the opportunity to.
Right.
So it's a totally different market. You couldn't cancel previously.
Yeah, no, you're absolutely right. Hey, Gloria asked a question. Where can I go to find this in my local market? You can try your board for some local numbers, your local builders association. Do what Keri did, go in the MLS and look at, I would add another thing I would do. I'd look at 2021. I'd start looking at 2019. And I'd say, where are we comparatively to 2019? Because what you're going to see is, even though we're in a decelerating market from a price perspective and a volume perspective, certainly we're ahead of where we were in 2019.
Yeah. And I even remember, it was at 2018 when there were primaries. Yes. I was selling a townhome in Santa Monica near the beach, and the market went flat. Like nothing around it was selling. Nothing was going into escrow. A couple new listings came up. And so we're like, hey, let's take a break. End of 2018, it was the primaries. And then beginning of 2020, we listed it as a pocket. We sold it 200,000 over as a pocket during the pandemic, and the buyer was like, absolutely not. I am not canceling. I want this property.
Right.
Like, what a difference, you know, and the market has appreciated consistently 2018, 2019, 2020. So these dips in the market are normal, and they're nothing to be scared about. Take advantage of these dips when they happen.
Yeah, absolutely. I think there are two things that we're seeing right now. The builds is a great question. We're seeing inventory come to market a little bit quicker. And I mentioned before, we're seeing it pool in the market. So
yeah,
anybody thinking about buying right now, I'd watch rates, I'd watch what's happening, but I think there is going to be opportunity for buyers coming up here. I used that quote before that was in an article today from CNBC saying there's a silver lining starting to appear in the market. And I think it's very, very true.
Yeah. If you see something you like, go for it right now. That's my advice. Yeah. Well, I can't thank you enough. This has been one of my favorite webinars, getting to interact with you on these things. You have so much knowledge, so much information. I mean, just, it's incredible. So we appreciate having Dave here today, and KCM. I love you guys. Thank you, Samantha, for telling us it was a great webinar. Thanks, Sarah. I miss you. Thank you, Anna, for all your help. Thank you, Bev. We appreciate being able to put out this information to people. And if you aren't registered for the Tom Ferry Success Summit, make sure you do that. Dave will be speaking with more amazing information. So more good things coming your way.
Absolutely. Keri, thank you for having me on. Thank you for the time and just your dedication to being the educator and being a leader. And we are grateful for it, grateful for all the help you give us at KCM. So know that.
Thank you. That made my day.
Good. Well, enjoy this day, and thank you so much for having me on.
All right. Take care, everybody. We'll send the recording out. Cheers.